My name is Felicia Malkin, and I am one of the board members of the SAC Carolinas. And most of you know me already, but I just moved to the Carolinas from Florida. I was there for the last 24 years and served as a president for SAC Florida for a couple of years. So I am here today to introduce Keith Hyatt of Breslow Starling CPAs. And as you may know, I am also a CPA, but not in public practice anymore. So I work for a company called PDI. We are a consulting firm, a business accelerator, and we help companies establish in the US and to grow their business here. So one of our offerings is the C-Suite Bridge. And this is where we step in and we help companies that might be new to the US or have a void in their leadership, and we help them boost those areas. So if it's sales or marketing, or in my case, I lead the accounting practice. So oftentimes I serve as an interim controller or CFO for companies, and I report back to their company leadership in the home country, which is oftentimes Sweden. So we do a lot of work in-house, accounting, sales tax, payroll, but when it comes to income taxes, we hand this over to the experts. So we have Keith here today from Breslow Starling, and he is a CPA. He has a long experience in international tax, which is of interest for all Swedish Americans. So with that, Keith, do you want to say a few words about yourself and your background?
Yeah, I'm happy. Thank you. I'm happy to be here and grateful. And it's that time of year again when everyone loves to look forward to doing their taxes, or they hate looking forward to doing their taxes. So hopefully we'll give you some ideas and thoughts and planning things to remember and think about as you go into this year. And if there's specific questions, we'll try to cover those. But my background has been, I started with a large international firm, Deloitte, and was with them for a number of years. And in that experience, worked a lot with foreign nationals who were coming to the US for temporary assignments, long-term assignments, as well as US expatriates who went overseas. And so when I left Deloitte after about 10 or 11 years, I came with the firm I'm with now, and we continue to do that work in the area. And so we try to assist companies all over the world, and particularly individuals who are the owners of these businesses. So that's kind of my background and helping.
Yeah. So I thought that we could start off with a few tidbits of what's new for 2021. So everybody knows that we're in 2022, but it's the 2021 tax year that we're working on. So anything that you want to share, Keith?
Yeah, there's new thing. I mean, there's several things to kind of be aware of. I mean, there are a few law changes. I mean, there were a lot of proposed law changes that they were talking about as of this past year. Fortunately, I say fortunately, they didn't go through, because I think a lot of them would have been detrimental to individuals and businesses. But they did increase like child tax credits. So a lot of people got this check in the mail monthly of child credit payments and an advance payment of that child credit, which usually you're filing your tax return and you're getting those credits. And so they got this check monthly. So when you file your return this year, you need to give your preparer probably two letters. One is a letter that says, hey, did you get any stimulus money, the stimulus check? And two, did you get any of these advance child tax credits? And so when you do your return, if you didn't get the stimulus check and you were due it, you'll get it. They'll include it with your refund. If you got the advanced child credits, then you don't get them again. You'll have to reduce the amount that you're entitled to. So it's something to keep in mind. In prior years, things like unemployment benefits weren't taxable income in 2020, but in 2021 they are. So there was a change there. So you kind of have to keep an eye on that change. Whereas I know, Felicia, you asked this question about the standard deduction versus itemized.
Mhm.
When they increased the standard deduction for individuals, they basically did away with the majority of people ever itemizing again. I mean, you can still itemize, but the standard deduction, for example, for a married couple is so large, it's like close to 25,000 or more, that a lot of people aren't able to itemize anymore. When you compare the two, when you compare itemized deductions to your standard deduction, the standard is more, and that's the one you choose. So
Yeah.
it's led to a lot of strategies that people need to think about now. They need to think about, how close am I to that line, that standard deduction, and does it make sense for me to bunch my deductions into 1 year? Does it make sense for me to double up my contributions? If I'm not getting the benefit from my home mortgage interest anymore, should I pay that off? Should I pay that down? What should I do? I mean, there's a lot of questions. Should I prepay my property tax before the end of the year? Is that something so there's a lot of things now that you'll look at differently, because if you can't itemize and you're not getting any benefit for those itemized deductions and you're using the standard deduction, maybe there's still a way to get the benefit for that. So that's something to look at.
Yeah, there was a lot of debate about the deduction of state and local taxes, and they had capped that to $10,000. Has that been changed now? They were going to lift that cap?
They left that cap in place, and it's capped at $10,000. So if your state tax and your property tax are more than that number, you're limited to the $10,000. Now, it's interesting. A lot of companies in a lot of states have worked out a workaround to this. Your flow-through entities, your partnerships, and your S corporations have identified ways that they can pay the state tax at the corporate level, and it doesn't flow through the individual. And by doing that, they're able to get around that. So certain states have adopted that. Not every state. North Carolina has been one
So
state
that's
that
a great
has.
tax planning tip. So somebody who might not be able to itemize anymore, but they have ownership in a flow-through entity,
Right.
they can actually pay the tax on the entity level. That's great.
Right.
So what about for businesses? I have lost track of all the acronyms for the different stimulus and incentives provided by the government this year, but there was the EIDL grant that could have been turned into an SBA loan. Then there was PP1, and there was the PPP2 round. Then there was also the COVID credits for family care and sick leave. So what about these? Are they going to be considered taxable income for businesses for 2021?
Great question. PPPs are not taxable for federal, and North Carolina was one state that was saying they were taxable for North Carolina. You had to reduce your expenses, but they since changed it. So we had to go back and amend a lot of returns. So those aren't income. Now the ERC, the credits you got. In fact, if you're a comp business, you need to really look at these employee retention credits and the family leave and all those credits, because those could give you a lot of money. We did several of those credits for companies, and we're talking $100,000, $200,000 for many companies of credits. Those, if you get those credits, you'd have to reduce your wages. You have to reduce the wage deduction. So but I'd rather get the credit than the wage deduction. It's more beneficial. So those are a reduction of the expense. So if you did get the ERC credit or the FSCRA credits, then you have to go back and reduce your wage expense by the amount that you used in the computation of that credit. So, but those are powerful credits. If you haven't got those, if you haven't looked at those, if your company might qualify, you need to look at that. That's a powerful.
So you're saying that even the credits, they sunsetted on September 30th, but if you didn't claim them in prior quarters, there's still time to do so.
Right. You need to look at that. There's some companies who've really got a substantial savings refunds from that. Yes.
Yeah.
Another thing for businesses, you mentioned another change for businesses, the meal and entertainment deduction. It's 100% deductible. So, the business lunches, the taking clients out to lunch are now used to be 50% deductible. Now they knew what havoc that wreaked on the restaurants. It just hurt restaurants and everybody else. So those are 100% deductible. Now in states, you have to be careful about states. Certain states are still on the old 50% rule. So you have to be careful there. But that's a big windfall.
Do you know off the top of your head which states are on the 50%?
Yeah, I know North Carolina is still 50%. I believe South Carolina is 100%. I'm not sure about the others, but I could check. Yeah, but
yeah,
you have to be careful, and states are slow to adopt. Federal government does something, but the states, they try to do their own thing. So
right. Well, that is great. So you guys hear that? 100% meals and entertainment deduction for going out for dinner, lunch. What about cocktails?
yeah.
100% deductible. All right. That's awesome. All right. Do you guys have any questions in the audience? You can raise your hand or just unmute yourself. If not, I have a few more questions to run by Keith if there's nothing from the audience.
Felicia, it's Reber. I have a question.
Yes, Reber.
To Keith, I thought I heard the other day, and don't take me wrong now, Keith, but I thought North Carolina had 100% deduction for meals and entertainment and what you talked about there, lunches, etc. So I guess I'm wrong then. And is that so?
Yeah.
You are.
Yeah. I don't believe North Carolina's adopted it. They're talking about it though, and danger with North Carolina is they'll talk about something after the fact. So for us, it means we have to file amended returns, just like the PPP loans. North Carolina came out and said, no, we're not following the federal. Those are 100%, that's 100% income. They since came out this year after all the returns were done and said, you know what, we'll let you do it after all. We'll let you, we won't make you add back that as income. We'll let you deduct, you don't have to pick that up as income. So we had to file several hundred amended returns for individuals and businesses that filed with that as income. So Reber, I mean, I'll check. I think we need to look again to make sure that, but I don't right now know.
Okay.
So if you reside in a state that hasn't adopted the federal rules yet, is your advice to hold off on filing? I mean, if you have a lot of meals and entertainment expenses, maybe it's a good idea to file an extension and wait for the actual filing. Yes.
You know what? People hate extensions, but I agree with you. That's sometimes a reason for doing that is extend. I don't think the IRS will come out and tell you this, but I think the longer you wait to file is probably not a bad idea in terms of not putting yourself in the, let's look at your return lottery. They look at a lot of returns and people argue that they fill their quota early on. So if you're filing closer to the deadline or after, you may not get into that mix. So it's not a bad idea.
Okay. Give you something to think about, but taxes are still due, right? So even if we file an extension, that is not an extension on payment, just an extension to file.
And unfortunately, it's, you got to pay your tax. Your best guess at your tax if you don't have all your information, depending on what you've invested in. I'm finding more and more people sometimes don't get all the information they need by the due date. And so we got to give it our best guess, but you're right, Felicia, you still have to pay your tax by that deadline.
Yeah, we want to avoid those penalties. So If we can dive into, because now we've talked a little bit about the developments for 2021, and especially state and local taxes and the differences between federal treatment and states of certain taxes. But let's look about international taxes and talk about US, Sweden in particular. So what about US residency? Who is a US resident for tax purposes?
You know, that's a great question. There's two tests, really. There's the substantial presence test, and then there's the, like the green card citizenship. If you get your green card or you become a citizen, you're obviously a US resident. I mean, you're taxed. But substantial presence test is kind of like a moving 3-year average test. If you're here more than 183 days and you were here a certain number of days in the prior 2 years, then you could become a resident as of that date you entered the US. So you have to kind of just watch it. In fact, part of this process is pre-immigration planning. If you're planning on coming to the US, you need to look at that. You need to look at, when am I coming? What's the date for my arrival? How many days have I been there in prior years, to kind of determine, because a US tax resident, unfortunately, is taxed on their worldwide income. I mean, once you become a US tax resident, you are taxed on all income, no matter where you earned it, where it derives from. So, albeit the US does allow a tax credit for, to eliminate double taxation, but still it can be a nuisance. It can be a real nuisance item. You come into the US and you're taxed not only on earnings that you're having in the US, but earnings you have still of funds you've left overseas. And that's a real sore point these days too, is that all these forms you have to file. I just talked to an individual today who, she has a mutual funds and an investment account in Australia. And we told her, look, you have to file a foreign bank account report, and you have to file potentially another form. It's another reporting form with your tax return if you exceed certain limits, and she does. So it's a whole new, not only does she have to file and pay tax on the income she earns in Australia, the dividends, the interest, the capital gains, but she has to file and report an information form that says, oh, I have this account and it's this balance and it's this amount and here it is and here are the account number. So every year she's having to file that for a couple of forms as well. So becoming a US resident is great, but it's also a tax.
Yeah. I think majority of us are not that proactive. I think especially coming from countries where there is a territorial tax system, you come to the US and quite surprised to hear about this worldwide taxation. So if somebody has not yet moved to the US, they're thinking about it, maybe they're being sent here by their company, what are some of, and you want to be proactive, what are some of your tips for kind of getting yourself best positioned to not have a nightmare tax scenario in your first year as a US tax resident?
Well, that's a great question. One thing might be you want to get rid of or transfer assets from, maybe you don't want to have any assets overseas. You want to divest certain investments in advance of coming to the US. You may want to maybe transfer them to a different individual, maybe have ownership of those. Maybe you want to move those literally with you to the US so you don't have any more reporting issues. It would pay to look at, once you become a US resident, what do I have to do for this investment? And is that a nuisance to me? Is that a hindrance to me? Do I want to get rid of that? Particularly if it's ownership. Yeah.
I'm sorry, are there some assets that are worse than others? Say having a US or a non-US bank account versus owning a corporation in another country? What are some of the worst assets you could have abroad?
The worst assets are a corporation, personal finance prefix, mutual funds that are foreign based.
I think a lot of us have mutual funds.
Yes, Yes. Those can be a real problem. The bank account's probably the easiest, right? I mean, because it has a balance, it pays interest. You know the account number, you can report it. It's probably the easiest one to keep that one. But when you get into more complicated investments like mutual funds, like ownership in corporations, closely held companies, partnerships, other rental property is not bad. If you own it outright, that's not too bad. Those are real problems in terms of reporting, not only in terms of how to get the information, but getting the information that's appropriate and knowing how you're taxed. It's really can be a real nightmare. We had a client who had from Canada who owned a lot of personal foreign investment companies, and it was just, the problem was not just only reporting to the U.S., but getting the information he needed to report it to the U.S. That was really a nightmare. So I would have preferred that he sold all these off and got rid of them, but it's easier said than done, right? I mean, it's easy to.
And I think I find also people that have been in the US for a long time, they're like, well, nobody ever asked me about these things before. But the IRS is getting more and more sophisticated, and they have agreements now where all of the countries have to report back to the US if US citizens have ownership stake in accounts or companies abroad. So that's great advice. So something I want to talk to you about is on the business side. So doing business in the US, say that, you know, it's a Swedish company that wants to sell their products in the US. Is it a good idea to set up a company in the US, or should they sell directly from their Swedish company?
Yeah, I mean, that's a great question. Sales in the US, you know, that we have a great treaty with Sweden, but this idea of permanent establishment, in other words, just sales to someone in the US aren't subject to tax here if you don't have a permanent establishment here. But the minute I guess it depends on the specific situation, but you know, you may want to monitor more. You want to more closely look at how things are being sold and how things are being distributed. So setting up a branch here or setting up a corporation here might be the best plan to do that. And that's where, you know, I think, Felicia, your company, your firm really helps people to do that, to really launch well in the US, to get the right structure when they're here, because it's one thing to sell something here. It's another thing to make sure it's sold right. You know what I mean? There's a difference, and to really launch it correctly. But the minute you do that and you have a permanent establishment here, then you're subject to US tax on your US earnings. So you've got a couple of reporting requirements. You got to be careful about the transfer price between the US and Sweden. You've got to be sure about what you're charging. You've got to disclose certain things in the forms, in the tax returns itself. But it's not a bad thing to do. I mean, it's not a negative.
Yeah. I always advocate for starting a US company if you're serious about investing in the US market. I think that's the way to go. But I have come across online sellers of consumer goods. You know, maybe they're not selling B2B, they're just selling to customers online, and they do that directly from their foreign companies. So so you mentioned a permanent establishment, so that if you're selling from a non-US company, you don't have permanent establishment. Can you just explain what that is?
You know, a permanent establishment is sufficient presence that says that you're here and your activity is more permanent in nature as opposed to just sales. It's kind of like the nomenclature of nexus, whether you have nexus in a state or not, you know. And if I'm just selling from North Carolina into Virginia, I'm not taxed in Virginia. But if I start sending people there, salespeople, if I start having an office there, if I start having I go there a number of times. If I start leasing equipment there, if I start having a number of just a real it's kind of I want to say sometimes it's a nebulous thing. It's kind of a gray area where you cross that threshold.
But is there a dollar threshold? Because when it comes to state nexus, there is economic nexus in some states. I don't know them off the top of my head, but some states where you don't get taxed until you meet a certain dollar amount. But is it the same with permanent establishment, or can it be $10 in sale or 10 million in sales?
Yeah, it can be. There's not a dollar amount, but 10 million in sales denotes something more happening than $10. But there's not a dollar amount. I mean, you're right. A lot of states have adopted that for sales tax. They were getting upset with people selling in their state and never paying tax. And states are hungry. U.S. states are hungry for money. They never get enough. So if they can find a way to tax you, they will. And that you're right. They came up with a dollar amount. Some states it's $100,000. Some states it's 100 sales. And so they want to, what they're saying is when you get to a certain level, they impute that you're there. Now, whether that'll be tried or tested in courts, it may be. I mean, so far it hasn't been. It may be challenged, but and so same thing with permanent establishment. And that's why I like your idea of why worry about it. Why not go ahead and just establish a company here, set it up, you know what you're doing, you have a permanent establishment, you know what you're going to be taxed on, you have certain expenses, you can kind of control to some degree your U.S. income.
Right, you're avoiding that gray area.
Yeah. So I think that may be a better idea. But yeah, there may be someday soon this idea of income level for permanent establishment too. So
it's an interesting conversation. Do you guys have any more questions for Keith? I have a couple of more questions if there's nobody else.
So Keith, this is Magnus in Raleigh. I had two pretty quick questions. Number one, where is your office located?
Yeah, we're in Greensboro, but like I say, we've got clients all over, so we kind of move. We go wherever they need us to go, but we're physically located in Greensboro.
Great. And my second question was, do you think that whole life insurance is a good tax strategy?
Whole life insurance, yeah, I think it is if you give it enough time. If you give it, I had an insurance agent just last week they were doing a presentation for using whole life insurance as a retirement plan for key executives. And her comment was, don't do it unless you have at least 10 years. In other words, 10 years of being able to invest in the policy, keep the policy. I don't know if you've seen this, but what's being promoted right now is that you invest money in a life insurance policy, whole life, for like 5-10 years, pretty substantial amounts every year, $10,000, $20,000 every year. And at the end of that time, you let it sit and you use it as a retirement vehicle, and you take money out tax-free 20, 25 years from now. And it's a very powerful tool. Now, the downside of life insurance, and of course, I'm not an insurance I don't sell life insurance, but is that there are fees embedded in life insurance. You're paying for the cost of insurance, but by overfunding that life insurance policy, you're also using it as an investment vehicle that you can pull that money out tax-free. So it's something to look at, but I'd be careful to get the illustrations I'd look at. I'd be careful about how long I'm going to leave it there, what I'm going to do with it long term. Does that help you a little bit, Magnus?
It did. Thank you very much. It did. Thanks.
All right, so another common question that I get is on the inheritance. Often, this is something that we might not, plan for. Somebody passes away and then we may receive an inheritance, or maybe you want to plan for who's going to receive your inheritance when you pass away. So what are the implications for a Swedish person living in the US if they receive an inheritance from Sweden?
That's a great question. You know, inheritance, the US basically takes a position that if they're just inheritances, we're not talking, you know, I'm getting a pension or anything like that, but inheritances are not taxable by the US. So gifts or inheritances. Now, so a living person, so if you or I inherit money from a relative in Europe or in Sweden, we do have to report it. There's a form that if it's above a certain amount, I think it's 110,000, it's an indexed amount, but you have to report it with your tax return. There's a form that is used to do that, whether it's a gift or an inheritance. But as far as being taxable, it's not taxable by the US. So you got to be careful. A lot of people don't think about that. If it's just $10,000, you don't. But if it's more, you have to report that inheritance. If you're a resident of the US, if you know, the question of estate tax comes. The US has a very large credit, but if you're a US domiciled individual, the US estate tax is going to be subject to estate tax on your worldwide assets. So if you die in the US, you know, and domicile is kind of like, back to our question about permanent establishment, you know, what's domicile versus, you know, I'm not, but if you're a US citizen and you die in the US, you're taxed on your worldwide assets, including assets located in any other country, Sweden or whatever. So it gets a little complicated from a domicile inheritance perspective, but depending on whether you're talking about living or death or that type of thing. So you just kind of have to look at—
What's the dollar threshold now?
You know, the US inheritance tax is right now is 11 million. In other words, every individual—
most of us on this call are probably not going to have to worry about paying tax on our estate.
I hope they all do. I hope they all are drilling for oil in their backyards, and they yeah. So, but no, most people won't have to worry about that. And the gifts, you know, probably not. But you know, it's something to think about. It again. You know, the problem of becoming a U.S. resident is, or a U.S. citizen and having dual citizenship or whatever, is income tax issues become worldwide issues. You know, you're looking at worldwide. You're looking at the issue of taxation. So
I think my takeaway here is that just like with the income, it's more of a reporting issue than a tax issue. So if you receive an inheritance from a relative in Sweden or another country, you're not going to pay taxes on it, but you will have to report it.
Yeah.
So it's more of an administrative exercise.
Right.
So I have one. Does anybody else have a question? I have one final question for Keith. So, so the US have this worldwide taxation concept where no matter where in the world you're living or where you make your money, you have to file your taxes in the US, right? So I have found many times that people have become US tax residents and maybe moved back to Sweden, or maybe they were born in the US and as a toddler moved to Sweden, never worked a day in the US, but then come to find out that all along they were supposed to file tax returns here in the US. Mm-hmm. So if many years have gone by and you've not filed in the US, what can you do to get caught up and to fix this?
That's a great question. We were looking at that specifically. The IRS had a program for delinquent or late foreign bank account reporting forms where you could go under their system, and the process for that was pretty, you know, streamlined. You could go through, you could get it all filed and get it in the system and get yourself caught up to date. As far as income tax returns go, you know, the problem with a statute never runs until you file a return. So if I haven't filed a return 5 years, a lot of people say, well, 3 years, the usual statute is 3 years. They can't go back more than 3 years, okay? But if you never filed a return, they can go back any period of time. So what we typically do with an individual who hasn't filed prior year returns is we try to get them caught up. We try to get them caught up with those prior year returns. Now, depending on what they owed and what they have done and the filing requirements, it could be they, you know, depending on, like you say, depending on what their income level was and whether they actually even owe tax, we would look at that, you know, and maybe we would catch up the prior 3 years to at least bring them up to speed and then start filing currently. I've had some people say, well, I'm not going back, you know, and we would inform them, we let them know, look, you know, these years are open, but they were basically taking the position that they didn't want to go back any further than the 3. Now the IRS can go back 4, 5, 6, 7, 8 years, but I don't know. A lot of people are taking the position that they have their hands so full with things they can't even keep track of what they've got, much less go back to prior years. So I would just look at it for a person. I'd sit down with them and say, let's look at the years that are open that you didn't file. Let's look at what income you had in those years, whether you even were required to file, first of all. And then let's look at what remedy and what we can do to file at least the prior 3 years and then go from there.
All right, that's great advice. So is the streamlined filing program that the IRS had, is that still open?
No, it's not. It's not open. At least they say they've closed it, but you know, I would still attempt to go under that. You know, if it was a foreign bank account reporting form, I would still try to go through that process and at least try to get into that system, because even though they say they've shut it down, they may still accept anything. The penalties for foreign bank account reports are so high, and they've been making examples of a lot of people. You've probably seen in the news, they publicize the big ones in the news to scare everybody else. I had a client come to me and said, you know, I've had a foreign bank account for the last several years, and there was $20,000 in the account. What do I do? And I said, well, you should have been filing a form. Let's file prior 3 years. Let's get you current. Let's get the current one done. And then let's move forward and hope that the IRS doesn't come back and say, well, where was the past 10 years, you know? And we've done that with many people and not had a bad response so far. I don't want to promise anybody anything or guarantee, but at the same time, for the people who have small amounts, I can't see them wasting their time on those individuals. I don't want to speak, I can't speak for the IRS, but I can't see them. They're going after the people with the Swiss and the Luxembourg bank accounts with $10 million in them, who've never reported the income, who've never done anything with them. Those are the prime suspects. So
yeah, they got bigger fish to fry. All right. Thanks, Keith. Lots of great info and advice. Anybody else have any questions for Keith or for myself before we end the call?
I've got, well, just as a throw out for everyone on the call, I've got an email update that I send out from time to time. Now, it may be kind of planning oriented, it may be tax oriented, maybe new law oriented. If you want to jump on my email list, you're welcome to send me your email and I'll add you. It's not junk mail, but if you don't want to, that's fine too. But I'll throw that as an offer. So
yeah, we'll follow up with everyone.
Yeah, Felicia, it's Magnus. I was just going to say the same, you know, the contacts to Keith, you know, so I don't know if you can send out an email with his contact information to the people on the call. That would be great.
Absolutely. I will definitely do that. And Keith, I'm so happy to have met you. You're a great resource. There's many CPAs, but they're few and far in between that have your expertise in international tax, and that's really needed among Swedish American both companies and individuals. So thank you so much. All right.
Thank you. My pleasure.
Thank you.
My pleasure.